The semiconductor industry has been flying lately. We've seen Nvidia fly, we've seen Broadcom currently fly, and we're going to take a look now specifically at AVGO, currently trading at $803 to determine if you're a shareholder, is it a good time now to sell, let it cool off as it's had a great run, or even as a potential investor, what price should we be looking to enter this company? And is it a great company or not? What we're going to do is take a look at the dividend safety. We're going to run through some really important financial metrics. And we're going to end the episode looking at the stock valuation model, looking at our 4 valuation models, getting to our intrinsic value, and looking at, with our margin of safety, what would be our acceptable buy price. Now, as you know, currently Broadcom has been flying. If we look at the last 30 days, it is up 27%. Now, a lot of money has been going into these stocks like AVGO, like Nvidia, and all these semiconductors and these chips. Now, what that means is the broader market has been pulling back slightly. So what we want to understand is there a reason for this, or should we be looking to either sell this stock or, as a potential investor, wait before we buy? Now, currently the yield is at 2.26% and it's trading nearly towards that 52-week high of $921. Over the last 6 months, this stock is also up 46%. And if you've been a shareholder for around 10 years, purely on share price appreciation, you're up over 2,000%, which is incredible. And that doesn't take into account the dividends, which are quite decent if you ask me. Now, let's jump into the dividend safety and some important metrics. So we can see here a dividend safety score of 67, which isn't as high as we've seen in our latest videos. But let's delve into why we think this is. Market cap currently at 335 billion. I believe Nvidia's is currently around 1 trillion. So, is there room for this company to grow? Is this company overvalued? Let's find out. Some key metrics, again, we're going to run through these shortly, but just to point out, the recession sales were negative 12.7% during the last recession. And if there is a recession going to happen, we want to find out what effect this will have on this company. The rest we're going to take a look at now. And just to note, in the last recession, AVGO were not paying dividends, so we are unable to see whether they maintained this or not. Now, dividend growth, one of the beautiful things about this company is over the last 10 years, their dividend CAGR has been 39%, which means if you have held this stock for over the last 10 years, your dividend on average has been increasing 39%. In my videos, I typically say you want to be hitting that sweet spot of at least 4% due to that being the inflation rate in the US over the last 30-40 years, and you don't want your purchasing power to decrease. But 39% over the last 10 years, 29% over the last 5 years, and 12% in their latest increase in December is absolutely incredible. Now, they have been having this dividend for 12 years, so long may that continue, and they will be on their way to dividend aristocrat status if they reach 25 years. So very positive at the moment. Now, again, we never look at any theory in isolation, but looking at dividend yield theory, it states that if the current yield is sitting above the 5-year average, it is undervalued, and if it's sitting below, like it currently is, it is overvalued. So potentially, this is the first sign of overvaluation, with the yield at 2.29% and the 5-year average at 3.26. Again, likewise, the 5-year forward PE has been sitting at 14. Currently, it's at 19.2. And just one thing to note, as we can see here, as it does seem to top, it does come down drastically. So in my opinion, so far, based on these two, it could potentially be overvalued currently. However, when we look at comparing Broadcom to the information technology sector, it is below 21.4. However, we don't know what bucket this is in, and we can take a look at this when we look at our valuations. Again, as mentioned, it is going towards that 52-week high. So, lots of different positive signs and things to be aware of. Earnings payout ratio, free cash flow payout ratio. I love looking at the free cash flow payout ratio. With the earnings, it's more susceptible to manipulation through earnings. So for me, I tend to disregard this for the majority of companies. But for potential investors, let's take a look. So for me, my golden dividend metric is that it is below 60%, so it can continue to grow that dividend streak. And as we can see here, for the large part, it is below 60%, excluding 2020. So for me, that's a positive. Likewise with the free cash flow payout ratio below 60%, 43% in 2022 in their latest report. So for me, very positive and lots of room to grow that dividend. Now this for me is probably one of the most phenomenal things that I have seen when covering stocks from different companies. Their earnings per share, again, I first look at that free cash flow payout ratio, but their earnings per share from 2013 to 2022 has increased astronomically, and I think the same we can say for free cash flow per share. If the company continue to increase in this rate, again, we don't know what's going to happen. This could be a very, very good long-term stock. Again, just because I say that, it doesn't mean we should be buying the stock straight away. We need to fully understand the valuation and other metrics. Now, sales growth, I personally prefer to look at 3 to 7%, but again, this is phenomenal. In the earlier years, 69%, 60%, 94%, it has slowed down, and the latest was 21%. When we look at it in terms of total sales, that is a lot to like. 2.52 billion worth of sales in 2013. 2022, more than 10 times, 33.2 billion. So incredible growth. Now, positive so far. Now, one thing where for me is a slight red flag, company like AVGO, I would expect them to either have a flat share outstanding or for it to be declining, as a declining graph is essentially when the company is returning excess cash to shareholders. But what this is effectively doing is diluting your ownership of the company if you had held. So for me, this is a slight red flag. However, again, we don't look at things in isolation. So this coupled with the other metrics for me is positive. But ideally, I would like to see this come down or at least remain flat. Return on invested capital, 10% and above for me is the sweet spot. And as we can see here, I would say on average it has been around 10% plus. There have been a few years where it's been below that, but overall on the balance of things, I think that's very positive. Now, operating margin, free cash flow margin, won't spend too much time, but above 16% for semiconductors, which AVGO have done, and above 5% for the free cash flow margin. Again, incredible, as we can see over the last 10 years, I'd say, well, the last 8 years, from around 27% low to 55% is very, very positive. Last thing I'm going to mention is around their debt in these metrics, net debt to earnings before interest, tax, depreciation, and amortization. So essentially we're saying in 2022 it would take AVGO 1.3 years to pay off its debt net of cash on hand. Personally prefer 1.5 on the grand scheme of things. I wouldn't say anything to worry about, but if we continue to see it go over this line over the next 4 or 5 years, could be something to take a look into, but nothing to worry me. Again, same here, below 0.4, which means in 2022, 55% of the company's financing was from debt rather than equity. But like I said, nothing really that worries me so far. Now we move on to the valuation system model. In my personal opinion, AVGO so far is a great company that I would be wanting to invest in. Again, not financial advice, but the most important thing is to ensure we get it at the right price. We want to buy undervalued dividend growth stocks. Now, we're going to start off with Graham's valuation formula. Smash the like button if you're enjoying the content. Smash the subscribe button, as it really does help me and the channel to progress, and I'll keep pumping these videos out day by day. So, we input AVGO, we input the earnings per share, $29.66. Now, the growth rate based on analyst estimates of around 10, and we input again the current yield on AAA corporate bonds, which seems to get higher and higher every day. Intrinsic value, surprisingly, $475, which is significantly lower than the current trading price, and actually, funnily enough, right at that 52-week low. So again, we don't look at anything in isolation, and we move on, and we'll consider that at the end. Multiples valuation. So what we're doing here is looking at companies similar to AVGO, similar sectors, similar business and size. We have Texas Instruments, Qualcomm, NXP Semiconductors. We input the stock price, input the earnings per share, and it gives us the PE multiples. We then get the average and multiply by the earnings per share to give a stock price of $487. Very similar to Graham's valuation model and towards the 52-week low of AVGO. Now, probably the most strongest point in terms of AVGO, in my opinion, in terms of their metrics, is how rapid they increase that dividend. Now, as we can see over the last 5 years, they've increased it around 50% 1 year, 22%, 10, 13, 12%, so quite high double-digit numbers. average growth of 22%, and in terms of the formula, we're getting the next year dividend over the cost of equity less the growth rate. Now, you're probably looking, why have I gone for a lower growth rate? I'm not convinced that they're going to be able to keep up these extremely high dividend growth rates over the next, forward looking. So I've gone for something around 7%. I think it's a bit more conservative, but I do not think it's unreasonable. This gives a DDM price of $984. Now again, it's right up there at the 52-week high. And this is why I say we never look at any model in isolation. We want to look at a few different models, understand them, and then use them effectively to get the average to get our intrinsic value. We then look at the discounted cash flow model and we get the free cash flows over the last 10 years. And look at this, we're looking at lots of high growth over the period, average 53%. So this is a company that is continually growing and fast. Now, I've gone with 10%, again, even lower than analyst estimates, because for me, I want to be on the more conservative side when I'm looking at this, and I'm not too convinced they're going to be able to keep this up for the next 10 years. I could be wrong, but again, this is the assumptions I'm making and I'm letting you know in the model. Future free cash flows is then derived from our growth rate and the terminal value. We then use our discount rate to get to our present value of future free cash flows, and we add these together with the terminal value, add the cash, subtract the debt, and get to our equity value. We then divide by the shares outstanding to get a DCF price of $970, which is in line with the dividend discount. Now, smash the like button, smash the subscribe button so I can keep pulling out this content, and put your thoughts in the comments so I know what you are thinking. Great, so now we have our 4 valuation models, and now our intrinsic value is essentially the average of these 4. So essentially we're saying the intrinsic value based on what we've just discussed is just around $730. Now the current share price is $803. Now typically I'd be looking personally for a margin of safety on a company like Broadcom at around 10%. If I really like it and there's something where I think this is a great company, which in my opinion it is, I would be happy with a 5% margin, but typically I like to see a 10% margin. So this would mean an acceptable buy price of $656. Just to show you, they were at that, I believe, if we just look at the last 6 months, if we look around here, they were around that not too far ago, over the last month in fact. So for me, it's not something that it's impossible. They have increased rapidly, so there is a strong chance of a pullback. Now for those that want a 20% margin of safety, and I think there's nothing wrong with that, $583, and that is well within that 52-week range, and again was probably around that not too long ago, I believe early March. So Wall Street price forecast over the next 12 months, they believe the price to come down in fact to $736, and the current price is $803. So in conclusion, my thoughts are that if I was a current shareholder, I would if I was a long-term investor, I would probably hold on to the stock. If I was looking to make a profit, I would probably sell, given that not only we've just run through the intrinsic value is lower than the current price, but also analysts and the evidence we have to back that up are suggesting the price will come down. Now again, we don't have a crystal ball, so we don't know when this will be. But as always, if you've liked the show, smash the like button, smash the subscribe button, and let me know your thoughts in the comments. As shareholders, are you looking to buy more? Are you looking to sell? And as potential investors, what price are you looking to get in at, if at all? Thank you and have a lovely day.